Have you wondered whether all sales growth is good, is adding value to equity investors? In this video, we look at how we can tell the difference between good and bad sales growth. Did you know that not all sales growth is good? Indeed, there is good and bad sales growth. But how do we tell the difference? Sales growth is a key driver of increasing the book value of net operating assets and increasing economic profit and cash flow, and the value of a firm. We talk about this in the video Sales Growth. But we know our sales force and marketers could generate sales growth by discounting price, offering additional benefits to customers, and increasing our firm's product range to increase customer choice, and so increase inventories and the general complexity and costs of its business. This could all be great for customers, but I've seen several businesses destroy substantial value for equity investors by uncritically pursuing strategies such as these to grow sales. Clearly, some sales growth will add substantial value to equity investors, while other sales growth will not. Some sales growth will be good, value creating, and other sales growth will be bad, value destroying for equity investors. So how can we tell the difference between good and bad sales growth? Change or growth in net operating assets depends on the interaction between sales and asset turnover. Growth in sales that keeps asset turnover unchanged will lead to growth in net operating assets. But growth in sales that reduces asset turnover, for example by requiring higher levels of inventory per dollar of sales to support a more diverse product range, or by increasing accounts receivable per dollar of sales to support more generous terms of trade with customers, would also lead to growth in net operating assets. However, is this necessarily a good thing for equity investors? We know that economic profit equals return on net operating assets less weighted average cost of capital, all times net operating assets. We also know that profitability, profit margin, and efficiency, asset turnover, are key accounting drivers of return on net operating assets. Actions to grow sales that reduce asset turnover will increase net operating assets, but will also reduce return on net operating assets. Depending on which effect is greater, this type of sales growth may increase or reduce economic profit, and so either add or destroy value to equity investors. Equally, growth in sales that reduces profit margin, for example through reducing prices while keeping costs constant, will also increase net operating assets and reduce return on net operating assets. Again, depending on which effect is greater, this type of sales growth may either add or destroy value to equity investors. It is critical to be able to distinguish between sales growth that adds value and sales growth which destroys value to equity investors. The economic profit framework provides a conceptual way of thinking about this and can help us identify good and bad sales growth. For further information on good and bad sales growth, go back to Chapter 5, Section 5.2 in the study guide. Also, review the Predicting the Future weekly questions. Also, answer right and rate questions on predicting the future in Peerwise.